Welcome to the deep dive. Today we're doing something a bit different. We're not just giving you a summary. Think of what you're about to hear as more like a meticulously crafted book extract, really distilling the most powerful, actionable insights from that legendary Buffettology series by Mary Buffett and David Clark. If you've ever read a really dense book and tried to jot down notes, but then when you look back, they're maybe not as helpful as you hoped, well, this is designed to be way more effective. We've aimed straight for the soul of these books, pulling out the absolute essence of Warren Buffett's enduring wisdom, highlighting the most valuable lessons so you can really grasp the core principles fast and deeply.
Yeah, and that's exactly what we're aiming for with this deep dive. It's meant to be a clear, sort of structured roadmap to understanding how Warren Buffett actually approaches the market. We're going to, demystify his unique philosophy for finding what he calls great businesses, and crucially, how he's managed to build such significant lasting wealth, even when the markets are going, well, completely haywire sometimes. By the end of this, you should have a deep, genuinely actionable understanding of what Mary Buffett and David Clark call his business perspective investing.
Okay, so let's unpack this. We're really diving into the mind of Warren Buffett today, but through this pretty unique lens. The Buffettology series, you might be wondering, who exactly are Mary Buffett and David Clark, and why should their interpretation of Buffett's genius carry, such weight for us?
That's a really great question because their perspective is, well, invaluable, I'd say. Mary Buffett, being Warren Buffett's former daughter-in-law, had this incredible 12-year access to his methods. Just imagine observing the Oracle of Omaha up close, day in, day out, right there in a family setting.
Wow. Yeah.
That's a viewpoint no journalist or academic could ever really replicate. And then David Clark, he's a recognized authority. He was actually a founding member of the original Buffettologists, a group specifically dedicated to dissecting and understanding Buffett's approach. So their combined insight gives us this amazing insider's view. It lets them translate what might seem like complex, almost intuitive insights into practical methods. Methods that are accessible really to everyone, from stockbrokers right down to, general readers. What makes their work so powerful isn't just what Buffett invested in, but really the why behind those choices. And crucially, how his philosophy adapted as his capital base just kept growing. This isn't some static picture. It's a dynamic understanding of a mind that's constantly refining its approach.
Okay, and this is where the story of Buffett's evolution gets really interesting, isn't it? His philosophy wasn't always this polished, buy and hold, great businesses approach we think of today. It went through a pretty profound transformation, moving quite dramatically from Benjamin Graham's idea of buying cheap companies to focusing on what he now calls great businesses.
Yeah.
That sounds maybe like a subtle shift, but it fundamentally changed everything for him, didn't it?
Oh, absolutely. It was a monumental shift, truly revolutionary in his thinking. Benjamin Graham, who was Buffett's mentor, famously chased what he called cigar butt stocks.
Cigar butts.
Yeah, basically companies that were so cheap, trading for maybe just a fraction of their liquidation value, that even if they were fundamentally, struggling businesses, you could pick them up, get like one last puff of profit out of them, and then just discard them.
Right, like finding a discarded cigar with one puff left.
Exactly. You're essentially trying to buy a dollar for 50 cents. Almost regardless of the actual quality of the business itself.
Yeah.
But Charlie Munger, Buffett's longtime partner and intellectual powerhouse, he sharply criticized this. He called it a snare and a delusion. Munger argued that, crappy companies often just never realize their supposed value. They just stay crappy. They consume management's time, capital, and you end up with a portfolio full of, well, perpetual underperformers. Think about maybe a dying industry. You might buy a company cheap, but if it's in terminal decline, that bargain just becomes a value trap.
That makes sense.
And this critique was absolutely pivotal. It led Buffett to completely reorient his focus. He shifted towards acquiring great companies with a durable competitive advantage, businesses that could consistently compound returns at really above average rates over the long, long haul, as Buffett himself famously put it. Time is the friend of the wonderful business, the enemy of the mediocre. And this completely redefined his concept of margin of safety. It wasn't just about getting a statistical discount on a stock price anymore. It became about the inherent resilience, the predictable growth embedded within a superior business model itself. That's a huge mental shift in how you view safety.
That distinction between cheap and great is incredibly clear now. So when we talk about these great businesses, what specific characteristics really define them in Buffett's view? The sources keep highlighting something called consumer monopolies as, well, basically the holy grail. What makes them so special?
Right, a consumer monopoly. It's essentially a business that holds significant economic power, often without being, a legal monopoly like the power company. The authors compare it to a toll bridge, an essential service or product that people have to use, or they're just so accustomed to it they're willing to pay for it, often at a premium price.
Like Coca-Cola.
Exactly like Coca-Cola or Hershey's or even See's Candies, which was one of Berkshire's earliest and most profitable buys. These companies possess what Buffett calls that durable competitive advantage, or a moat. It protects them from competitors and sustains their profitability over, decades. They usually benefit from low overhead costs because they don't need massive constant capital spending. And critically, they have that power to set higher prices without losing tons of customers because their product is either unique, essential, or just well-loved. But what's really unique, and the point the authors stress, is they're often small net tangible asset base that they almost never have to replace.
What does that mean exactly?
It means their real value isn't tied up in things like factories or machinery that wear out and need replacing. It's in their brand, their loyal customers, their distribution network, intangible things. This makes them incredibly resilient to inflation because they don't need to keep pouring money into replacing physical assets just to stay in business. A really insightful test the authors suggest is this. If you had billions of dollars and the 5 best managers in the world, could you launch a company to successfully compete? If your honest answer is a definite no, then you very likely found a strong consumer monopoly, a business that's just incredibly hard to disrupt.
Okay, this whole philosophy, moving from cheap to great, focusing on these consumer monopolies, it sounds like it requires just an immense amount of patience. Is that really connected to what people often say is the biggest secret to building wealth?
Absolutely. Spot on. The Buffettology series emphasizes this unequivocally. Compounding is the primary secret to getting significantly wealthy. It's not about finding the next hot stock or timing the market perfectly. It's about letting the magic of compounding work its wonders over very long periods. Buffett advocates holding investments for decades, what he calls compounding long and hard. And this commitment to holding long-term also inherently minimizes your transactions. That drastically cuts down on taxes and fees, letting more of your returns actually compound.
Right, the friction costs.
Exactly. The goal is to stay the course, and maybe most importantly, to resist panic selling, especially during those inevitable market downturns. It's really a test of emotional discipline. I mean, think about it. It's almost always better to consistently hold a great business that reliably returns, say, a predictable 20% a year, letting that compound for decades, than it is to chase some quick, rare 35% gain that immediately triggers taxes, trading fees, and is much less likely to be repeatable. Real wealth isn't built on quick flips. It's built on that relentless, quiet power of compounding over time, and that requires both patience and deep conviction in what you own.
So you understand the kind of business these consumer monopolies. You're committed to the long game. How does Buffett actually analyze them? I mean, he's famous for meticulously digging into the details, right?
Yeah.
Not just reading headlines. What does his actual financial toolbox look like?
You're right. He's definitely not a superficial investor. He insists on turning every page of a company's financials. And that's not just a metaphor. It means he meticulously examines all the public documents filed with the SEC. We're talking 10Ks, 10 keys, 8Ks, a whole lot.
Everything.
Everything. It involves a deep dive into the balance sheet, the income statement, cash flow, management's discussion, and crucially, all those footnotes that people often skip. He wants to understand the business as if he were considering buying the entire company, not just, a few shares. This rigorous process is vital. It's the only way to truly grasp a business's operations, its strengths, its weaknesses, its competitive position. It's how you genuinely unearth those fundamentally strong businesses that can keep their moat for decades. Anything less, really, and you're just speculating.
Okay, given that deep financial dive, are there specific numbers or metrics that really jump out in his analysis? I imagine he's looking beyond just, say, revenue growth.
Exactly. Mary Buffett and David Clark highlight several key quantitative measures he uses to spot these high-quality businesses.
Like what?
Well, first, return on equity, ROE. He wants consistently high ROE, ideally 15% or higher, sustained over a 5 to 10-year period. And for folks tracking financials, ROE is key. But for Buffett, it's the consistency over a decade that signals efficient use of shareholder capital without piling on debt.
Right, not just one good year.
Precisely. Then gross profit margins. He looks for these to be consistently above 40%. This isn't just about looking good. It points to strong branding, market dominance, that pricing power we mentioned.
The ability to charge more.
Yes, pricing well above production costs, a hallmark of a consumer monopoly.
Okay, what else?
Debt to equity DE ratio. He strongly prefers minimal debt, ideally not higher than 0.5. The idea is growth should come mainly from equity and retained earnings, not loading up on borrowed money, which adds risk.
Makes sense. Less leverage.
Less leverage, less risk. Next, free cash flow, FCF. He loves businesses that generate lots of cash without needing constant, huge reinvestment in capital expenditures just to stay competitive. A free cash flow to revenue ratio above 5% is a good sign. It means the business is really throwing off cash that can be used wisely, not just feeding the machine.
Cash is king.
Absolutely.
Yeah.
And finally, perhaps most critical, predictable earnings. The ability to forecast future earnings with reasonable confidence is paramount. Without that predictability, any attempt to value the company is, as the source says, mere speculation. He wants businesses whose future isn't a total mystery. He also focuses on something called owner earnings, which is a refinement of free cash flow. It gives a truer picture of the cash actually generated for the owners after all necessary capital spending.
Got it. Strips out some accounting noise.
Exactly. Gets closer to the economic reality.
And it's definitely not just about the spreadsheets and numbers, right? What about the people actually running the company? I imagine even a fantastic business can be sunk by bad leadership.
You've absolutely hit on a critical point there. Buffett places immense importance on the quality of the management team. He looks for honest, highly competent managers who are, above all, excellent capital allocators, people who know how to deploy the company's earnings wisely.
How they spend the profits.
Right. Whether it's reinvesting smartly in the business, making smart acquisitions, or buying back shares effectively. He famously quipped, "I try to buy businesses that are so wonderful that an idiot can run them, because sooner or later one will." But even saying that, he still wants great management. As the source puts it quite powerfully, a good business with bad management is a bad investment, whereas a bad business with good management can still be a good investment. That just underscores the pivotal role leadership plays. Brilliant management can sometimes turn around a tough situation, but poor leadership can definitely destroy even a great business.
Okay, so you've done the hard work. You've identified a great business, strong moat, solid financials, good management. What are the next practical steps? How do you actually apply this to build a portfolio? What comes after finding that ideal target?
Well, the fundamental principle is actually surprisingly simple, but incredibly difficult for many people to actually execute consistently. You first determine what you want to own. That means identifying that company with excellent, consistent economics, a predictable future, that durable competitive advantage. Then, and this is absolutely crucial, you wait for a good price.
The patience part again.
Exactly. This is where patience meets opportunity. Why wait? Because the price you pay directly determines your potential rate of return. Even the best business in the world can give you poor results if you overpay for it initially. Buffett aims for an expected annual compounding rate of return of 15% or higher. So he won't just buy a great business at any price. He waits until the math works out to potentially hit that return target over time. That signals a sufficient margin of safety from a valuation perspective.
So discipline on price, not just quality.
Precisely. It's a disciplined approach to value.
And once you own it, how does that business actually grow the wealth in Buffett's strategy? Is it just hoping the stock price goes up, or is there something more fundamental going on inside the company?
It's largely about optimal capital allocation within the business itself. Buffett sees all earnings, whether paid out as dividends or kept by the company, as belonging to the owners to him. And he places tremendous importance on those retained earnings being reinvested effectively. He and Charlie Munger generally prefer companies that don't pay dividends or pay very small ones.
Really? Most people like dividends.
They do, but Buffett sees every dollar paid out as a dollar that can't be compounded within the business to fuel future growth, potentially at a higher rate than the shareholder could achieve elsewhere. They want management to reinvest those earnings wisely back into the core business, into smart acquisitions, things that strengthen the moat and grow earnings power. They also emphasize the strategic use of what they call other people's money, or OPM. Yeah, the classic example is insurance float from companies like Geico, which Berkshire owns. Insurance companies collect premiums up front, but they pay out claims later, sometimes much later. This creates this huge pool of cash, the float that doesn't belong to them, but they can invest for their own benefit in the meantime, essentially interest-free.
Wow, like a free loan.
Exactly. This float significantly amplifies investment capital without having to borrow or issue more stock. As the book quotes, quite provocatively, to become a billionaire, you have to get other people to give you their money to invest. This concept of using cheap money like float is a really powerful, often overlooked accelerator for wealth building.
Okay, this sounds quite different from the standard advice about diversification,
Yeah.
spreading your money across lots of different stocks and bonds. Does Buffett really push back against that?
Oh, he absolutely does. It's a stark contrast to traditional diversification taught in Finance 101. While conventional wisdom says spread your money thinly across many companies to reduce risk, Buffett champions a highly concentrated portfolio, just a handful of excellent businesses.
Just a handful.
Yes, this focused investing approach is based on the idea that if you really do your homework, if you deeply understand a business, its economics, its management, its moat, then you don't need to diversify widely. In fact, he argues holding too many companies can dilute your best ideas and makes it impossible to truly know what you own in sufficient depth. As he puts it, owning only great businesses means less diversification is necessary. He believes concentrating your capital in your very best, most understood ideas can lead to superior returns while actually lowering business risk because you know those businesses inside out.
Like his big bets on Coke or Amex?
Exactly. Think of his famous long-term holdings in companies like Coca-Cola or American Express. They perfectly fit that mold. Consumer monopolies, predictable earnings, low capital needs. He understands them deeply.
We've talked a lot about building wealth in good times, focusing on these amazing businesses. But what about when things get rough? Market crashes, economic downturns. The new Buffettology specifically tackles how to navigate, maybe even profit from those challenging times, right?
Yes, absolutely. And that's where the new Buffettology really provides immense value. It was published back in 2002, significantly after the dot-com bubble burst and the whole Enron scandal.
So, perfect timing for bad markets.
Right. It makes it highly relevant for guiding investors through exactly those kinds of challenging conditions. It emphasizes Buffett's selective contrarian investment strategy for evaluating what he calls down stocks. It really serves as a kind of roadmap for investment success, even when, most people are running for the hills.
So it's fundamentally about seeing opportunity when everyone else is panicking, finding bargains in the fear.
Precisely. The core idea is to exploit what the authors call the bad news phenomenon. That's where the market drastically overreacts to negative news about fundamentally great businesses. This emotional overreaction pushes their prices way down, often creating this huge gap between the temporary price and the long-term intrinsic value. So while others are fearful, selling frantically, caught up in the herd mentality, Buffett's eyes actually light up.
He gets excited.
Yes. His strategy, described vividly in the book, is to jump on these dips with a ton of cash, buying as many shares as he can.
Yeah.
The authors claim that applying the strategy correctly to these down stocks, these temporarily out-of-favor great businesses, can yield enormous profits with, and this is key, almost zero risk to your capital long-term.
Almost zero risk seems strong.
Well, the almost zero risk part comes because you're not speculating on failing companies. You're still focused on those intrinsically strong businesses. Businesses whose long-term economic power and value will almost certainly prevail, regardless of the short-term market noise or panic. So it teaches us that market downturns aren't just something to survive. They're actually significant opportunities for long-term wealth creation if you have the discipline and the contrarian mindset. It really underscores the vital importance of emotional control and keeping that long-term perspective. The classic Buffett line, be fearful when others are greedy and greedy when others are fearful. Mary Buffett and David Clark's Buffettology series, I think, has just done an extraordinary job demystifying Warren Buffett's methods. It really weaves together intellectual discipline, that crucial emotional control, and a deep, deep understanding of business economics. It integrates the qualitative side, like identifying those powerful consumer monopolies, with very precise quantitative filters, like looking for that consistent high ROE and low debt. This holistic approach ensures you're buying businesses with real demonstrable economic power, not just, chasing numbers on a screen or following the latest fad. It's this combined strategy, I believe, that fosters both the intellectual rigor you need to analyze businesses properly and the emotional resilience that's absolutely crucial for long-term success in investing.
So thinking about everything we've discussed, what really stands out to you, our listener, from this deep dive? How might you start to filter out all that market noise and apply these principles? Thinking like a business owner, not just a speculator, in your own investment journey. Remember, true business quality tends to show up in consistently superior financial performance and that durable competitive advantage. The answer really lies in continuing to learn, digging into those business realities, and basing your decisions on that, not just on what the market's doing day to day. We really hope you found this deep dive valuable.
And to join us on this ongoing intellectual journey to help enrich our work and guide future projects, we definitely invite you to subscribe, contribute with your comments. We love hearing from you, and support us with your likes.